All right, let's get a gauge of what to expect on the local market at the Open. It is just under an hour and a half away now. We are joined now by Chris Weston from IG in Melbourne. Chris, great to see you there. Now, I just wanted to ask you about the moves in oil. It's just really hard to try and explain, I guess, when you look at everything else going on in markets. That tumble of 4% down to around the $88 a barrel mark. What do you think was behind it?
Yeah, and I think we should celebrate this, to be honest, Bridie. I mean, this is a situation where global growth has been under pressure. We reacted yesterday, obviously, to the Chinese non-manufacturing numbers, which sort of showed what's happening there. Global growth next year should be just over 3%. And I think that's what we're seeing. We're seeing this catch-up trade that's coming through in both WTI and Brent. So Brent price is what trading from I think we went home yesterday. They're trading around $111. 0.72 per barrel. WTI prices trading around 91.74. So they've come off about $4. 3 or 4% apiece. I mean, that's a massive move in the oil market. I think you can look at the term structures, you can have a look at the futures and say that there's massive contango going through there. There is not a supply issue at the moment. I think there's a supply-demand issue, and I think that's really what we saw. Some of the media were reporting that we did see this increase in supply coming through at the backdrop of an increase in output coming through. But if you actually look at the amount of output that's been recorded by the Energy Department, it was 11,000 barrels. Now, that's on top of the 6.5 million we're producing, or the US is producing, or the world's producing a day. That's a rounding error in my mind. And then if you actually look at the inventory numbers, they came off. So I think the media are pointing out that this was a supply issue that's come through the Energy Department and their figures. But I don't buy it myself. Okay, fine, you've got a situation where output's the highest since 1996. Demand's fallen to the lowest levels since April, so obviously that supply-demand side of things has been pushed into question. There was no real ramp-up in geopolitical situations last night. Okay, you've got Turkey versus Syria, that situation's coming up, and there was more talk of that. But I don't think there was any reason to suggest that was appeasing the situation and warranted a 4% decline. Okay, if you look in Iran at the moment, we've seen what's going on there. There's big protests over the weakness that we're seeing in their domestic currency, the rial, and potentially that could be a bearish situation for oil in the sense that the regime change looks like it may really happen. People in Iran are really not happy at the moment. There could be a case where there could be regime change in the near term because of the economic consequences we're seeing being put in from Europe and the US as well. And generally, I think the market get this anticipation that if we do see a new regime coming through in Iran, that could coincide with an increase in Iranian production coming forward. But no real technical breakdowns that we saw in oil. But the big $4 drop in Brent and WTI, again, that feeds into heightened consumer spending further down the line. So, clearly oil at $88 is a lot better in where we are compared to $100. So I think it's just the price of WTI, the price of Brent, catching up with the price with global growth at the moment. It's been held up really remarkably by some of what's been going on with the Middle Eastern tensions. I think also what we did see in terms of US markets, the markets probably liked it. The oil and gas space was down significantly, down over 1%, which you'd expect to see. But the data we saw in the US last night was a little bit mixed. I mean, most people are saying the ADP number was better than expected, which is great. But if you actually look at last month, there was actually a pretty sizable revision to the downside. You can actually look at the ISM service numbers, which on a headline number actually was very strong, significantly above expectations, showed good expansion coming through. But if you look at the employment subcomponent of that, it fell from about 53 down to about 51. So that was a little bit weaker. And again, perhaps last month's revisions to the ADP number and also the employment subcomponent could put some downside premise on Friday's non-farm payrolls print, but we didn't actually see any revisions to that. But overall, I think the S&P got a bit of a lift from that data. It was up 0.6% and then fell away into the close at 0.4%. But yeah, I think everyone's trying to explain the moves in WTI. How did it drop so significantly when there was no real technical breakdown? The geopolitical situation hasn't changed remarkably. And I think the output figures that were put out by the Energy Department really don't suggest a 4% drop-off in the price of WTI. So no real smoking gun. I just personally think it's the energy price catching up with the global growth story now.
Looking though, I mean, it was interesting. John Noonan from Thomson Reuters just making the comment that there's a lot of, conflicting themes, disjointed price action, a lot of mixed signals going on in markets at the moment. It's really hard to kind of put things down to fundamentals or try and explain action on markets at the moment. Is that because we've got so many key events coming up, do you think?
Yeah, I mean, I I think what we're seeing at the moment is so many different asset classes. The correlation trade has broken down a little bit. I mean, people are now talking about iron ore prices. You know, they don't really correlate with anything, to be honest, and that's holding up at the moment, and that will continue to hold up this week. The price of gold was up $4 last night from our cash close, whereas we saw copper down about 0.5%, whereas we saw WTI and Brent prices collapsing, as I said. There's going to be a lot of thematics. I mean, just in the next 24 hours, obviously we've got the FOMC minutes, which are going to come out at 4 o'clock in the morning. I think about 11 o'clock this morning, going through most of the day, we've got these live presidential election debates, which are going to come with Romney and Obama, and you know, these really throw off. Whilst Obama's winning quite nicely in the polls, and the bookies have got him as big favourite at the moment. Yeah, these live debates are where people can really slip up, and I think people are going to be watching this intently going forward. I don't think it's potentially going to be a massive market mover of stocks. I think tonight we've got the ECB rate decision. I don't expect anything too major from that, as well as the Bank of England decision. Probably the big moves are going to come from the Bank of England in November, when their first QE programme comes to an end. They're probably likely to initiate another 50 billion worth of gilt purchases then. So I think in the near term, there's not a huge amount that's going to create a massive amount of uncertainty. But the markets right now, in terms of risk assets, are waiting for Spain to happen to request assistance. You know, we're hearing one day that they're ready to request assistance, and the market loves it, and the next minute they're pushing that back. And Mr. Rajoy is talking about pushing that back until perhaps even October, late October, if not now November as well. So we're just getting these conflicting signals in so many different asset classes. It's very, very difficult to trade now. Okay, you can look at the crosses in the Aussie dollar and say there's some really nice trends there. But I think in terms of the sort of majors and of the equity market at the moment, the equity market looks exhausted. Probably wants a 5% pullback. That would be very healthy indeed, I think, to try and get some better levels in this. But different asset classes, very, very difficult to try and trade these markets right now, Bridie.
I just want to ask you then about the opening call for the Aussie share market. Obviously, it's going to be an interesting day. As you mentioned, there's so much coming out. But we did see those retailers and housing stocks do quite well yesterday with the rate cut. What do you think? I mean, is it going to be more of the same today?
I think so. I mean, the trend in these housing stocks is very, very strong right now. I mean, CSR from the lows, well, they got down to $1.14 and a half. It's up to 46% from the June lows there. Borrell's had a 30-odd% gain since those June lows. James Hardie, which makes probably about 70-odd% of its revenue and earnings from the US, has been rallying since August 2011. That's been helped out quite nicely. Again, that's broken. That's got a really nice uptrend. But CSR and Borrell for me have just broken out. They're probably the trades that I'd be wanting to be leveraged to. Obviously, the building approvals numbers at the moment, that's old data. We're looking forward in terms of these housing stocks right now, with the rate cuts potentially coming down to 2.5%, or the interbank market's pricing 2.25%. That has massive upside potential for housing starts, not for 2013, but for 2014, and that's what the market's trying to price in right now. Housing starts next year are expected to drop, 0.7%, but into 2014. It takes 15 months for the interest rate, for building approvals to really react to interest rate cuts, and the first interest rate cut, remember, November 2011. So this is what we're trying to price in forward looking. So we're seeing some nice breakouts in CSR, Borrell, Fletcher Buildings, those names as well. Good gains in the last, since mid-September in JB Hi-Fi. That's up 15% since those times. These are where the flows are flowing at the moment, as people look to price in aggressive rate cuts coming through. So JB Hi-Fi is one that I'd want to be long into Christmas, and perhaps Harvey Norman as well, given it has that housing start exposure from the white goods side of things, as well as the discretionary spends. But the broader market, 10 points higher on the open thus far. The energy sector predictably should come under a bit of pressure given the moves we've seen in Brent and WTI. Gold stocks may open a little bit higher, although that Newcrest ADR is down about 15 cents. And I think BHP, it's going to be interesting. The ADR closed down 0.3%, so a bit of a headwind. But we want to try and see the market close above that 44.48 level. We traded above it yesterday, failed to close above it. So clearly the bears are enjoying their time above that level at the moment. But a close above 44.48 would certainly be a big positive, and suggest that the bulls have got this firmly in control going forward.
Chris, just quickly, if we could, we're just getting an announcement through from ANZ, and I just wondered if we could let viewers know, and perhaps we might be able to get some initial reaction from you about this. Just interesting, ANZ coming out and saying it's going to implement a major investment program for its Australian business to try and make it easier for Australians to bank with the ANZ, up to $1.5 billion of the existing investment plan will be directed to this program over the next 5 years. So a major refurbishment program of branches, and it's going to roll out video conferencing within remote branches to help with regional customers getting better access, and do all kinds of other types of mobile banking apps and mobile wallets and this sort of thing to try and get customers over to ANZ. What do you think of the banks at the moment? I mean, there's been a lot of focus on them, hasn't there, Chris? You know, given the rate cut and whether they're going to move. We know ANZ obviously doesn't release its decision until Friday week, but what do you think? I mean, is this just part of that strategy of trying to win customers at the moment, given that the credit growth has been so slow?
Yeah, credit growth's slow. You know, business lending's not particularly great. I mean, yeah, you're right. I mean, this is about trying to win over customers. It's not going to have an immediate effect, of course. This is going to be one of those situations which trickles into consumer satisfaction, I suppose. So I don't see this having a great effect on the share price. $1.5 billion for these guys who are generating these kind of returns is not a significant amount of money. But yeah, I think in a market which is very tight at the moment, these guys need to win over as much as they can. I mean, they've got some great products at the moment. They've got a great app as well. And I think these are the sort of things we want to see happening, because at the moment, I think if you're looking pure valuation, the banks to me probably a little bit lofty. I think if they're trading at the top end of the range of their price to book valuation range over the last couple of years. They've been trading between 1.4 times to 1.8 times. They're trading at the top end of that. We know the dividend story has been relatively compelling, and that's why people have been buying banks as a sort of quasi bond, I suppose. But interestingly, if the rates are coming down, if the term deposit rates are going to be coming down as well, and they're not fully passing on, I think that would be good. Fully passing on the rates, that would be obviously very good for their net interest margins going forward. But I think as well it makes their dividend yield even more competitive, because if term deposits are coming down, savers out there are saying to themselves, well, I'm not getting the great returns that I did once. Again, it reinforces that yield story that's so vivid in this market. So I really don't expect to see banks pulling back significantly while they still have a reasonably attractive yield compared to the cash rate. I expect banks to be really nicely supported on dips going forward. But the upside, I think, right now is still quite limited, and I don't expect a huge amount of upside. So perhaps range trading in the near term is a good idea in terms of banks.
You are so good on this spot, Chris. We really appreciate that instant analysis. Thank you so much.
Cheers, Bridie.
Chris Weston there from IG. Well, of course, as we know, the Reserve Bank cut rates